So Chuck and others, please feel to jump in as well. How are the major capital markets players, investment banks, hedge funds, insurers, others, looking at the sort of nascent but growing ISA marketplace, and what will it take for those larger players to eventually become significant funds providers if they aren't already?
All right. The last 4 years has been a big education process for the institutional community. I would say that at this point, they completely understand ISAs as an asset class. They appreciate the investment points about them, which are, number one, this is a major social impact investment. There are only so many wind farms these ESG funds can invest in. And every dollar of ISA is another student loans off the street, and that's considered a social good. And so a lot of the participants in our market are ESG and social impact investors. Number two is these are attractive yields in a zero interest rate environment where BBB bonds are yielding 2.5%. The double-digit returns available in our marketplace are very attractive. Number three is, because they're tied to wages, this is viewed by investors as a major play on inflation. A lot of people pay up for inflation protection in their portfolio to protect against inflation eating away at their holdings. But by receiving a fixed percentage of wages, you can actually participate in inflation. And I think there's more demand overall in the market to invest in ISAs than there actually are ISAs in the U.S. And part of that, I would say, is thankful to the good performance. So I would say that Austin, for example, has done an incredible job managing through the COVID economy. We priced a sizable pool of ISAs for Lambda School in January, and we were not anticipating a global pandemic and record unemployment. And that pool is actually outperforming initial expectations. And that's a kudos to the education community for being able to do that. Also, I would point out that Lambda School, they're not selling their ISA contracts off to the street. They're selling pro rata participation rights, and they're maintaining a lot of the risk, which is a major signal both to students and the marketplace. And literally the largest institutions in the world would take chunks of $50, $100 million ISAs. Were we able to originate them, which I think we will be.
Yeah, I would add to that, Chuck. I'd say, I definitely do see an increasing number of inbounds from investors that are really interested in the space, looking to learn more. And as you look at players who have great outcomes like Lambda or like Thinkful, you'll see more come to the space. I think the three biggest drivers for how we'll see growth from investors is really around scale. As ISAs become more mainstream and more easily adopted, you'll definitely see investors that have minimum size allocations, like $100 million, like the large bank, being able to actually invest in the asset. The second is really just around data. As more and more data comes around repayments and performance, you'll see investors get comfortable around the risk, especially given these are non-regulated and not rated yet. The third is around regulation. Obviously, we saw 2 bills proposed in Senate that have seen bipartisan support, and that would be a huge tailwind that would really help increase capital in the space. And the last thing I'd mention is really the benefit of ISAs to really shift income curves and drive increased performance. With a loan, all of your best performers are capped at that interest rate. With an ISA, you have the benefit of being able to truly align the incentives of that cost and value of education and also drive students toward better outcomes, like Lambda and Thinkful do through their career support offerings. And similarly at Stride, we bake a lot of that into our offering itself. And so I think that itself will give investors a lot of comfort around the expected return.